Okay, my clock says 1 o'clock, so let's go ahead and start. So we're going to talk about cyber insurance today, the good, the bad, and the ugly. Some of it's good, some of it's bad, not much ugly, actually. And we're going to talk about cyber insurance in the broad sense of cyber insurance, not just cyber liability insurance. Some of this is semantic, but I want to, I've broadened the topic out. So we're talking about a variety of things. So we're going to talk about cyber and privacy liability insurance, data breach mitigation, which is typically a part of the cyber liability policy. We're going to talk about computer fraud, funds transfer fraud, which often has a computer component to it, debit card issues, and then coverage on computer equipment itself. And those coverages are in a few different policies. So we have management liability insurance, which is sometimes called D&O insurance. Actually, that's a misnomer. D&O is a part of management liability. What we have in management liability is D&O, employment practices liability, lender liability or banker's professional liability coverage, fiduciary liability, and then cyber liability is also a part of management liability. The fraud bond is most often called the bond or the financial institutions bond. I added the descriptor fraud to the word or the phrase fraud bond because it dawned on me 10, 15 years ago, probably 15 years ago now, that that's the only policy that I can come up with in the insurance world where there's no descriptor in the word. You can't pick up the policy and look at the policy, the title at the top. You can't look and say, this is coverage on X. So your auto insurance, you know what that is. Workers' compensation, property insurance, general liability. Most insurance policies, health insurance, life insurance, disability insurance, there's a descriptor in the name. There's something in the name that says what the policy is covering, what's a bond. So I added the word fraud because almost everything in that policy has to do with protection of the bank's assets from some kind of fraud, broad definition of fraud, theft. And then we're going to talk about the package policy. So the coverages that are, looks like we've got a, I'm looking at the comments, and it looks like we've got, Rick, are you having audio problems? Everybody else can hear me, right? Well, I'm going to keep going. Same here. Art, you were hearing me okay a few minutes ago. Can you tell me if you can hear me now, please? Apparently we're having sound issues. All right. Art tells me that the audio is working, so I know it's working for some of you. Apparently there's an issue with Internet Explorer, but folks are using Chrome, and that's allowing them to access. If we do have a problem, those of you on the call who are having audio problems, well, I'm going to move forward for those of you who can hear, and the audio recording will be available for folks. In the past, I have had problems with some firewalls not allowing people in at banks. So apparently some folks are having issues. But I'm gonna move forward because some people apparently are able to hear me. So we're going to talk about management liability, the fraud bond, the package policy. So let's start off with the cyber and privacy liability policy. This is lawsuit protection. Again, this is part of management liability, and what we've got is coverage for lawsuits coming out of the computer in some fashion. Most of these claims are going to be data breaches. And so the bad guys hack your system and get access to private information. There also is coverage within most cyber liability policies for accessing funds that by computer that causes some kind of is a wrongful act and causes some folks issues there. So cyber and privacy liability insurance, lawsuit protection arising out of a computer. This is my bank insurance book. Quick little ad here. My thinking for bank insurance issues is included there. If you go to bankinsurancebook.com, you'll be able to access the book on Amazon. If you look at the bottom, there's also a link to a website where I've downloaded the entire contents of the book, and I'm making adjustments to the contents as my thinking and as the world of bank insurance changes. So you're always going to be able to access my current thinking on bank insurance issues at that web page. Breach mitigation is a part of your cyber liability policy. So a minute ago I talked about the lawsuit protection, and that's going to be coverage for defense costs. It's also going to be coverage for the ultimate award against you that happens in a court or a settlement that's made through a negotiated process. Breach mitigation is the cost that you incur immediately when you know that you've got a data breach. And what I talk about with my clients is the idea that if you have a data breach, we know you're going to spend money mitigating that breach. We know you're going to notify your customers that their data has been compromised in some fashion, that you're going to have to notify your customers of that information. Breach mitigation expense pays for the expenses, the costs to notify, and those costs tend to be around $100 to $200 per name. Those costs are going down. 5 years ago, I was talking regularly about $200 per name, and now we're down around 100 and perhaps lower. There's some competition that's entered the marketplace for offering services for breach mitigation to banks and to other financial institutions. So that's driving the cost down. But we know that you're going to spend money here. You may never get sued. You could have a data breach with 5,000 names and no lawsuit ever materializes. And the regulators look at the way that you've addressed this through your mitigation efforts, and you may not have a regulatory issue, you may not have a lawsuit filed against you by a customer, but we know that you're going to spend money here. And at that $100 to $200 per name lost, that money can total up pretty quickly. So if you have a breach of 3,000 names, right there, you've spent $300,000 to $600,000. So I look at breach mitigation as being the most important part of the cyber liability policy. I'm still seeing, go back to that page, I'm still seeing banks without mitigation coverage. So they're buying cyber liability insurance, but they don't have any coverage for the mitigation expenses. I'm seeing many banks at $250,000 of coverage here. To me, $500,000 is the minimum for even the smallest bank. So take a look at your policy, make sure you've got at least $500,000 of coverage there. And on this slide, down towards the bottom, you will see my website, howmuchbankinsurance.com. So the smallest banks, I think, should have $500,000 worth of breach mitigation coverage. As your bank gets bigger, I think the amount of insurance that you should be buying should grow. And you can find my recommendation at howmuchbankinsurance.com. So there's two ways of buying cyber liability insurance. Option one is a separate policy. And that separate policy may be with the same insurance company that you have your management liability with, your D&O, your employment practices coverage, your lender liability insurance. So it may be with the same insurance company, or it may be with a completely separate insurance company. So, for example, the Travelers always uses a separate policy. It'll be a Travelers policy, but it's a separate insurance contract for the cyber liability and mitigation expense coverage. The ABA Everest program always uses a separate policy. Again, it's the same insurer, but a separate policy. There are times, and for some banks, a better option than using the same insurer as their D&O, the management liability, employment practices, coverage, fiduciary liability, lender liability, is a separate insurance company. So you've got a separate policy with a separate company. The premier insurers for that are Beazley and Ironshore. Ironshore is now part of Liberty Mutual. The Beazley policy is an exceptional policy, and Beazley is probably the preeminent insurer of cyber liability for financial institutions around the country. So I have many clients with Beazley as a separate policy. There are many times, though, when the prudent approach is to have the same insurer for your cyber liability and for your other management liability coverages. I counseled clients more often 3 or 4 years ago to use a separate insurer because the quality of some of the insurers' cyber liability policies were inferior to what was being offered by Beazley and by some of the other specialty cyber insurance companies. That's starting to change. The Travelers has introduced some new coverages. A couple of years ago, the ABA Everest program improved their coverage dramatically and the services that they offer. There's an advantage to having the same insurer on your management liability and on your cyber liability coverage, and that is I can construct a scenario where we have a bond claim, a management liability claim, and a cyber liability claim all in the same event. And if you have one insurer for all of those coverages, that might be an advantage. But we have to look at the quality of coverage. The idea of having the same insurer on all of your coverage is obviously that's an advantage. But we need to make sure that the coverage is adequate as well. So there still are instances when I'm recommending a separate policy for the cyber coverage. Some insurers have their cyber insurance as a part of the management liability policy, so it is the same contract, the same policy as your employment practices, lender liability, and the others. It's a coverage section there. AmTrust uses cyber liability as a section of the management liability. FinSecure, One Beacon also has the same. Cincinnati uses the same policy as well. So you've got to look at the insurers and the advantages of their coverage forms and the services that they provide. An insurer like Beazley 5 or 6 years ago offered dramatically better services than the standard bank insurers. Again, the other insurers are catching up. ABA Everest has improved their program dramatically, and I've got many clients that are insured by that. As I mentioned a couple of minutes ago, howmuchbankinsurance.com is a resource. I regularly update the amount of coverage that I recommend for banks of different asset sizes, so you can see what I recommend for your bank for both liability, cyber liability coverage, and for breach mitigation. And then I've got recommendations on the other lines of insurances as well there. As a reminder, I'm glad to take questions. Post them up in the chat box area, and I'm very glad to answer questions there as they come up. That's why every once in a while I glance over. I'm getting some private messages as well as individual messages, so it's a little distracting, and I apologize for that. Let's talk about computer fraud here, and now we're talking about the fraud bond and losses to the bank. So these are what we call first-party losses. No lawyer is involved. You're not being sued here. But there's been some issue that's caused a loss of bank assets. So hackers have stolen your money. Employee dishonesty is a part of the fraud bond. Perhaps an employee has been involved in a computer fraud event. A virus can infect your computer system. And obviously theft of bank funds. So there's computer fraud coverage within the fraud bond to protect the bank's assets. Cyber extortion coverage, ransomware is probably the most prevalent area of claim within this area. Traditionally, the kidnap and ransom insurance within the fraud bond has included coverage for extortion. And almost all of the insurers have now evolved their extortion coverage to include e-commerce extortion. There can also be coverage for cyber extortion within some specialty cyber liability policies. I mentioned Travelers a minute ago. The Travelers has cyber liability policy, which includes obviously cyber liability, regulatory liability issues. Then it also includes the breach mitigation, and they include a variety of other coverages, one which can be cyber extortion. So we can have coverage under the separate policy or under the cyber liability policy, or we can have coverage within the bond. Almost all bonds do include cyber extortion. I used to be a stickler on the duplication of coverage. So if somebody had a Beasley cyber liability policy, I would want to make sure that we were removing coverage there for cyber extortion and depending upon the coverage within the fraud bond. I'm kind of moving away from that now. Ransomware events, I won't say claims, but ransomware events are becoming prevalent. I'm not sure I've talked to a bank recently that hasn't had some kind of ransomware event. They've all been fictitious. I cannot recall, actually I have not had a ransomware claim event that turned into a claim. In all cases, they've been fictitious. So the president of the bank gets an email saying, we've infected your system, and the IT department goes through the computers. They don't find anything. They don't pay the ransom, and it turns out there was nothing there. So there's never been I've not been involved in an actual ransomware attack claim that was real. So I'm starting to allow for some duplication of coverage here. The premiums are pretty small. If we ever do have a real ransomware event, I'm not sure that having duplicate coverage is going to be a real problem. I'm also seeing some differences in how definitions are put forth in the bond and in the separate coverages. And the vagaries of the cyber world are such that to try and categorize all events within one definition sometimes is pretty difficult. One key thing to look at, and I just became aware of this a few weeks ago, some insurers in their definition of extortion are only providing coverage for money. And they define money as a unit of exchange or a mechanism of exchange issued by a government. And that would remove protection for Bitcoin. So we need to make sure that the definition of extortion is not so narrow that it doesn't pick up or doesn't miss what will certainly be the most common demand in a bank extortion attempt, and that is payment in Bitcoin. I think it's silly to think that a cyber attack against a bank, the bad guys are going to demand a paper bag of money at a local convenience store be exchanged. They're certainly going to demand Bitcoin, and so we want to make sure that the definitions of extortion pick up payment in cyber currency of some kind. The bonds all seem broad enough to pick up Bitcoin, by the way. Funds transfer fraud. This coverage within the bond, the fraud bond. You're going to have funds transfer coverage. It might be within your computer coverage. Sometimes it's a separate line of coverage. Look for callback warranties. Look for requirements that a particular callback procedure is followed. Most policies have a limit that say if a funds transfer request is over X number of dollars, tends to line up with your deductible, then you must perform a callback. And you must keep a record of the callback. So there must be some form of notation, documentation, a logging of the callback call that is done at the time that the callback is made. Some insurers are requiring audio recording. CNA has several times tried to work with a policy with one of my clients or with my clients that require an audio recording. So there is actually a recording of the funds transfer callback so that you can hear both sides of the conversation. I get that removed. look at your policy, talk to your agent, make sure that's not a requirement of your policy. If it is, ask that it be removed. At some point, that may be standard practice, standard requirement. Right now, it is not. Social engineering coverage is a relatively new coverage within the last 2 years. If you're coming off of a 3-year policy, or you're in the second or third year of a 3-year policy, you might want to have your check with your agent about adding social engineering coverage. 2 years ago, several insurers were not offering this protection. The difference between social engineering coverage and funds transfer coverage is whose money is involved. Funds transfer fraud is your customer's money is being fraudulently transferred. Social engineering coverage is when the bank's funds are being transferred fraudulently. So the bad guys get in touch with a clerk in your bank, and they request that funds be sent to a bank in the British Virgin Islands, pretending to be the president of the bank, and that's fairly common. Again, all of the banks that I've talked to recently have had at least an attempt of social engineering fraud loss. Have not had a claim yet. Everybody's caught it in time. Coverage limits tend to be fairly low, $250,000. Your best bet is to make sure that your procedures and the process that your branch managers are following, and the folks that do transfers are following, so that they actually know funds are being transferred to. A couple of times now in the past week, I have heard of spoofing a phone number. So the bad guys are able to spoof the president's phone number, or are somehow able to change where that phone number is pointed. So the callback is actually being made to the president of the bank's phone number, but somehow that's getting shifted around and moved. I don't understand the technology, but have some provision for a secret code word or something like that, so that not just through the callback, but that you're talking to the right person, and that this is a legitimate request of bank funds being moved. Debit card fraud. This, again, is a part of the fraud bond for many insurers. Most insurers offer this coverage. It's for fraudulent debit card events that take place. The deductibles on most fraud bonds for debit card coverage are fairly high, $50,000, $75,000, $100,000. And that's what moves this out of the realm of covered claims in most cases. I question the value of this coverage for most of my bank clients. I don't see it as a particularly valuable coverage because of those high deductibles. And quite frankly, debit card losses are a cost of doing business. And to me, technology is the way to prevent these losses from occurring, making sure that you're taking advantage of your system tools so that you can limit losses. Debit card losses are high frequency. They happen all the time. Low severity. The dollars tend to be fairly small. And that's just not a good realm of insurance. If you're building floods every 6 weeks, I'm not positive that flood insurance is the solution to your problem. And we're going to have a tough time finding an insurer to provide that coverage for you. Chartis Insurance Company does offer what they call the bank card protector, and you can use that policy. Chartis was formerly known as AIG. Large insurer. The bank card protector premiums range from a couple $1,000s to tens of thousands of dollars. Again, I don't see this coverage as particularly valuable, but if you are risk averse and you don't want uninsured losses of even $15,000, $20,000, then the bank card protector is something to look into. Computer equipment are in the package policy. We're covering the actual computer equipment. This is where your computers are covered for fire, windstorm, vandalism, the physical destruction of your computers. My recommendation is almost always that you have blanket coverage, meaning that you don't have a specific limit of insurance at each of your branches, at each of your location, but you have one large amount of insurance that one large amount of insurance that covers all of your locations. Computer equipment coverage quite often includes some fairly low dollar amount of coverage for virus and hackers. Again, we look to the fraud bond to provide the bulk of coverage for computer virus and hacking events. I've talked about this a couple of times. Here I'll mention it again, howmuchbankinsurance.com, a resource for you to see my recommended minimum limits at various asset sizes for the different types of insurance policies. Let's talk a little bit about strategies, insurance buying strategies. We are in a very competitive bank insurance marketplace and have been for some time now, 10, 15 years. If you are financially stable and you don't have any regulatory issues, a strong bank, you will have no trouble getting 5 or 6 quotes for your management liability, your fraud bond, your cyber coverage. Insurers are looking for quality banks and are offering competitive proposals. I am moving away from the idea of bidding a bank's insurance every 3 years. My concern is that we have been in a buyer's market for a very long time. And at some point that marketplace is going to change. And I am advising many of my clients when they are teamed up with the right insurance company to sit tight, but to work strategically in managing their renewals. So let's say that you are a bank of $750 million. You've been insured with the ABA Everest program for 6 years. You've had no claims, and the bank is growing at a moderate pace, and no regulatory issues, no claims issues. My approach to that renewal would probably be to have the agent contact ABA Everest 4, 5, 6 months in advance of the renewal, and to get an indication from them as to what they're considering for renewal premiums. If a market like ABA Everest would be amenable to a flat renewal for the bank that I've just described, I would be inclined not to go out into the marketplace. Again, assuming that we've got the coverages that we need, and they're offering that competitive premium. Your premium should not be changing much from 3 years ago to today. Again, assuming no claims, no regulatory issues to speak of, and strong financials. If you've grown dramatically in asset size or you've made some acquisitions, then you might see a bump in your premium because of that. But I do have some bank clients that have grown rather dramatically and are still seeing flat renewals on a three-year policy. While we're talking about 3 years, almost every bank under $3 billion, billion with a B, $1 billion, should be offered a 3-year policy in the current marketplace. 1-year policies for even. I've got a bank at about $3.5 billion. We have just finished their renewal, and for the second time, we've gone into a 3-year policy. A couple of years ago, the line seemed to be $1 billion that insurers were not offering banks over $1 billion. But for any bank, again, under $3 billion, you probably are going to be able to get a 3-year proposal. A bank that is heavily traded on a public market might be the exception to that comment. But if you're closely held or a mutual bank, you're not going to have any trouble getting a 3-year offer. And if your insurer won't do it, suggest that you can find another insurer that will, and your insurer may come around. I still like the idea of locking in 3-year policies. By and large, it is the best way to move forward. YouHaveBankInsurance.com is a repository of well over 1,000 articles and blog posts that I have written over the years on bank insurance and general insurance issues. Use that as a resource. There's some of my past webinars there, some videos. Feel free to use that. I am very open to taking questions. Now that for at least the majority of you, it looks like Chrome is the way that you went, and that so we've got those out of the way. Feel free to ask me questions. I'm glad to stay on the line. My phone number and email is also on the screen. feel free to send me private messages. I'm glad to respond if I can help in any way. We've been on for about 30 minutes now. I'm going to wait another minute or two to see if questions come up. And if they don't, we'll end the call. Drew, Rick, you're very welcome. Art, certainly. Absolutely. Glad to. I'm also glad to take questions outside of cyber liability insurance. If you have those questions, I can certainly take those. All right. Well, our attendees are dropping quickly, so and there are no questions popping up. So I will sign off at this point. The replay of this will be sent to each of you. The link to the recording of this session will be sent to all of you. Again, I'm very glad to answer questions by email or by phone. Just give me a shout, get in touch. Thanks for being on the call.